What's good, guys? Today I thought I'd just make a quick little video, a little Q&A here to answer some of you guys' questions you might have, maybe some video ideas that you guys would have that I could just turn into a question and answer very, very quickly here so that we can answer any or the most questions possible, get the most value out to you guys as possible. So we'll get this started right away with the first question, which is, will you explain more about SMT and when to apply it? So very, very simply put, SMTs are divergences between NQ and ES or any other pair that are correlated to each other, like Euro USD and GBP USD, right? So what you want to look for in an SMT is one that aligns with your trend and your bias and your drawn liquidity, if possible. So let's say your drawn liquidity is higher. You would want a bullish SMT at lows, right? So that there was a liquidity sweep on one, the other didn't, showing more strength. Um, so if I could explain it as much as possible, you want to align yourself with time as much as possible, and you also want to have a significant SMT is what I like to call. So there's some SMTs that are slightly insignificant, especially when it's going down. Let's say it's like catching a falling knife, right? If the SMT is with your trend, so let's say your trend is bullish, and you have an SMT at some highs. I value this a little less unless I'm already in a trade and it's like at an all-time high or something like that. Then maybe, but ideally you want to use SMTs as an extra confluence, not enter based solely off of that and kind of go and build on top of it. Like, oh, I have an SMT here. What happens now? Oh, we break structure back to the upside, inverse value gap in the 5 minute or something like that. Then you have your confirmation to enter. The SMT is like a little cherry on top, right? So if I was to show you a chart example, give me 1 second, we'll get right to that. So a good chart example right here would be this low here that we put in the AM. This is a 9:30 AM low. We kind of broke back above, and now we created this nice SMT. So on ES, we swept that low. On NQ, we didn't. Right at 2 p.m., which is the PM session open, right? So we get that, and then we get, let's say, an inverse fair value gap right here. Enter off this candle, and you can target this high, this high, this high, and these highs here. Now, if this SMT happened at the highs or something, I would be a lot less likely to take it because you are bullish. Let's say you wanted to go take out these equal highs up here. If this high had taken out this high here, let's say we had a bearish SMT, that would have been a great entry for short as well. And I also said that in my backtesting session yesterday. I'll say it again today. You want to enter on the pair that's the weakest, which means that in this case here, you would want to enter on the stronger pair. Actually, I should say when it's on the bullish SMT, which is this one here, which will stop at the SMT low. Because realistically speaking, right here, ES could go all the way down to here if it wants. As long as NQ doesn't take this low, the SMT is still valid. This low right here, right? So you want to put your stop right there, and NQ can do whatever, or ES can do whatever it wants as long as NQ doesn't go back here. This is now a protected low. So if I was to mark this out and enter this trade or something, I would put it like this, and then right here in my templates, I have protected. This means that this should never get taken, or at least not until the draw or the next high is taken, right? So we'll see how that works out for tomorrow. But basically, that's what SMTs are, right? You want to align them with your bias, your trend, your draw. As always, you can align them with time, which is a session open, 10 p.m., whatever. A clear liquidity sweep happens at the same time. Great. And you don't just use those. You don't just enter a trade based off the SMT. First of all, again, you need your trend, your bias, and your draw. Then you can have time as well. But then if you can get, I don't know, an inverse fair value gap or an SMT that gets into a fair value gap like this, that's also awesome, right? So with that, we'll move on to the next question. So right here they ask, give us a rundown on your strategy and how we can apply it. So my strategy is basically it's kind of complicated and simple. I'll say it again. I need my trend, I need my draw, and I need my bias. From there, my bias, let me move on to the chart really quick. My bias can be to, let's say, take this high and then go lower. This can be my bias. With that being my bias, I will not be trading this leg because it's kind of very small and stuff like that. But then once that happens and I get confirmation of my bias, that's when I'd be willing to enter on this leg down here, right? So again, trend, draw, bias, and then right after that, once I have these three, I'm looking for where would the market react, and that's basically anything. It could be a higher or low, it could be a significant higher low, it could be a fair value gap, it could be an SMT, it could be OTE, it could be a rejection block, it could be an order block, it could be the world is my oyster, right? It could be anything I want. And then once I have a significant place in the chart at a significant time where market does react and goes back into my trend and my draw and my bias. So let's say I'm looking at this chart here, right? We're just going to be using this right here, right? The trend is obviously bearish right now. We're in a bearish trend, right? We're making these lower highs and lower lows like this. Now, once I get back to an area of interest, let's just say for the sake of this video that it's OTE, right? So from this high to this low, OTE gets respected right here. We're at an area where we could bounce, and you see how we're bullish here? This, to have a trend, you need highs and lows, okay? So basically, you don't want to enter your short here or here. You want to enter it here as much as you can, right? So when you're bearish with your trend and you have a drawn liquidity lower, and also your bias is to make that higher low and then go lower, from there you can pinpoint a point on the map, or on the chart, and say, okay, it could bounce here. Realistically, it could bounce here, it could bounce here. Me, that's how I do it. It could bounce this fair value gap. Let's say I'm just going off like the 15-minute and just like something like that, right? It could bounce off this order block, whatever, right? It could bounce off this bigger time frame breaker over here. See how this breaker aligns with OTE? That's great. Now, again, trend, bias, draw, time, if possible. Where could the market bounce? Now, realistically, I wouldn't be a huge fan of it bouncing over here because that would be a big move up. Here is ideal, right? So market should bounce here. Now, once you see the market starts to do that bounce, so that continuation for your trend, the question is, how do I enter? So drop down some time frames. Was there an inverse fair value gap? Maybe. Was there a change in the state of delivery? We had a big impulsive value gap here on the bull side. Is there a inverse fair value gap that gets created? Right there, it gets inverse, retrace back into it, and you can take that things to multiple lows. So I'm gonna go over it again one more time. Okay. So trend, bias, drawn liquidity. It should go trend, drawn liquidity, bias, because if your trend is bullish, we're at all-time highs, the only real drawn liquidity you have is the all-time high. So so it's kind of, it becomes internal trades and stuff like that. That's a whole nother thing. So I'll go again. Trend, drawn liquidity, bias, time, not necessary, but very, very good to have. Like 100% of the time I would take it over not having it. And then from there, where could the market bounce? How do I enter? Those are the only questions I ask myself when I'm trading. Okay. So hopefully that kind of answered that question, and we'll move on to the next. So this guy said his analysis is the hard part. Basically, if you guys want to see how I analyze the market, you can join the free Discord. Again, it's free. You can just watch me live trade, or you can join the backtesting sessions. I also host in the Discord for free as well. And you guys can just watch how I analyze the charts and how I kind of go through the psychology of things and stuff like that. Real quick, I just want to address this little comment here that was in between the Q&A, where this guy said, much respect, I'm here to get the discipline part down. You can clearly see JD knows what he's doing and he's very good at it. And this other guy said, oh yeah, I've been in here since end of April. He got me way better. I just want to say I appreciate this so much, guys. Again, doing social media has always been a dream of mine, right? And I kind of figured with the whole trading thing working out, I've been trading for 6+ years. It'd be good to kind of launch myself into some things I would normally not be able to do. And I really, really, really appreciate these comments, and I'm so happy that I can help you guys, right? And that's the only reason why I'm doing that. It's not like I'm getting paid. It's like I always say, I'm not getting paid for anything, right? So I really, really, really do appreciate these comments, and I love seeing that you guys like what I'm putting out. I love seeing that you guys enjoy the content and just kind of learn from it, and your journey becomes a little easier because of me, and that just means the world to me. So I just want to take a little second here to answer that. Not really a real question, but I just wanted to kind of get it out there because every time I read these comments, my heart is just filled with like love and just feels very heavy. So I'm just gonna want to get it out there, and now we'll keep going. So this guy asked, a good question would be why fibs are important to judge order flow, and that is a really good question. And I see a lot of people saying, I think he even said it. He said if you look at BTC, whatever, I was thought that the market is rigged and that price just bounce off different areas. Now, let me tell you exactly why the market is rigged. It's not actually rigged. There's a whole explanation there, and I actually learned it in my early days, so I'll tell you right now. Why does the market always bounce off this? No matter where you put it, you'll always find that the market ends up bouncing there. Not always, but more often than not, right? So if I was to put it from here to here, it doesn't quite get there, but almost, and like, it's one of those things where once you see it, you can't really like unsee it. You know what I mean? Like even if you were to go on the hourly chart, I'm sure wherever you put it, that's where the market will bounce. So that's how let's take, I don't know, this. You know, it's so close, it's almost laughable. And anywhere really that you put it, that's just, or there was a reversal, but that's just where the market will bounce. Now, a lot of people ask, why is that? Well, on the math side of things, 0.618, or I'm guessing when you say Fibonacci, you mean the 618 to the 786. So 0.618 comes straight from the golden ratio, okay, which is about 1.61. Now that number is not random. That number shows up everywhere, right? In nature, sunflower spirals, pine cones, seashells, even pineapples. I'm pretty sure. Even the arms of galaxies is correlate. If you were to Google that, you could get down a very, very deep rabbit hole, right? Even in the human body, right? Like the ratio of your forearm to your hand, or the navel to your total height. Even in art, and architecture, I'm pretty sure, like the Parthenon or the Da Vinci Vitruvian Man, right? Those are all, it's just a number that comes up naturally in nature everywhere you look. You could really go down a super deep rabbit hole. I know I have. Okay, and I'm not remembering every example. Obviously, so many of them, right? And the 0.786 level is simply the square root of 618. So it's a mathematically related deeper retracement level. Okay, so these aren't random numbers. They come from a universal growth proportion that humans instinctively recognize as balance and symmetry, right? Now, when you apply that to the market, the picture makes more sense. After a strong impulsive move, price needs to retrace to reload on orders, right? The 50% level is just balance. Equilibrium, it's the midpoint. It works as well, right? Institutions don't want balance. Okay? They want either a discount to buy or a premium to sell. And that's why the 618 and the 786 pocket gets so much attention. It's deep enough to accumulate size without breaking the overall structure of the trend. You can keep your trend going while loading up as much as possible on your bag. On the money side, this pocket is where psychology and liquidity line up as well. Sorry about that. Early traders who bought too soon often get stopped when price dips through that 618 level. Traders who think the trend is over get baited around that 786, right? So that builds a huge pool of stops and pending orders right in that zone. Smart money uses those orders for liquidity. So they'll push price into the pocket, sweep stops, and then reverse hard in the original direction, which is also why usually you'll see inducement. So you'll see some little candles, and then you'll see that big move down to the 618, and that'll sweep all these little lows that were created, and then when the move can continue on the big time frame, right? Finally, there's also the self-fulfilling side, right? These levels are coded into retail fib tools and even institutional execution algorithms, right? So enough traders watch them, so liquidity naturally kind of thickens there, which makes the reaction even the more reliable, right? So the reason market respects the 618 and the 786 is simple. The math gives us objective universal proportions, and the money, liquidity, right, makes those proportions a practical place for big players to do business, right? Also, these levels don't work in isolation. They're just location. You still need confluence structure, liquidity pool, session timing, market context, whatever you want, right? To make them high probability. And one of the main reasons why I like them so much is I'll tell you right now, and you tell me if that makes sense. We'll take this leg like we did before, right? The one that went in the OTE. So let's say this little 5 minute leg here from the London high to the low. We did sweep OTE. I can even put it to Asia high, I'm sure, right in there, right? What's the better RR? The half stop at the high, TP at the low, or just slightly above for a 1 to 1.6 instead of a 1 to 1 to 1, right? This is a 1 to 1 or a 1 to 1.6, right? So you get that RR extra, the extra probability of being profitable simply from filtering out some bad trades and also from getting a better RR, right? If your RR is slightly bigger and you weed out some bad trades, just right there, just off math and probabilities alone, and that was for me that was enough to use this tool. By the way, the probabilities and the RR difference and stuff like that. Obviously with confluences to take the trade as well. This would be where could the market retrace, and then you still need to how do I enter the trade, right? So if you don't have any entry confirmation, you still don't enter that trade. But guys, it's almost kind of magical when you think about it that you get a 1.6 RR basically like with a really good win rate just off one little tool, right? And if you were to enter at equilibrium, again, you get a 1 to 1. Institutions don't love that, and I don't like that. A 1 to 1.6 means you could win one trade, or you could win two trades and lose one, and you're still in profit. Think about it. Actually, I'm not sure what I said with revenue. I'm gonna need to run the math, but I'm pretty sure. Oops, sorry about that. I'm pretty sure that the RR of 1.6. I don't know the exact RR to win rate to be profitable, but I know it's much, much, much better than 50%. When you get a 1.6, it's probably around 70%. You're still real good profitable. You could even be at, I think a 1.3, you're profitable at 50%, and then I'm pretty sure. So a 1.6, you would probably be profitable at like a 45%, right? So you wouldn't even need a 50% win rate to be profitable with this. So that's basically all the questions that I had for today. Hopefully next time I do one of these, you guys have different questions, and it could be more, could be less, whatever. But just I'll be doing these quite often. So if you guys want to join the Discord, ask questions, I can answer them in a video like this. The link's gonna be in my description for the Discord. As always, again, it's free. And other than that, guys, don't forget to like, comment, subscribe. If you guys have any questions, you can drop them in this video right here, and I'll answer them in the next Q&A. And I'll catch you guys later. Peace.